Good morning, everyone. Thank you for joining us today for this update on income provider. I'm joined by Kotze, the portfolio manager, one of the team of income provider. I'm Darby Carstens, looking after the Western Cape. We thought to do today's session slightly different to the past ones, trying to make it a little bit more interactive. I think the monotone of all the webinars we've had in the past makes it become boring. So I'm going to post a couple of questions to Henk throughout the session. I'm going to post your questions that you asked to us to Henk as you ask them. So not at the end of the session like in the past. So please use the Q&A function on the Teams. Just use the Q&A function and I'll ask the questions as they come in. I think as with any virtual session, please bear with us if there's any technicalities. And with that, I'll then just jump right in. Henk, I think just quickly the agenda. So we're going to cover where income provider, where the name comes from, where it all began, why we started the fund. Henk will work through macro themes, easy money, the inflation debate. We'll work through that in a bit more detail. How that translates into our interest rate outlook, current positioning of the fund, how do we find these real yielding opportunities? And then looking ahead, what's the risk that we see and what's the best way to manage that? So jumping right in, I think we haven't done this in the past, so we thought to give you a story of where income provider came from, how we came to name it income provider, why it was created, etc. So Henk, maybe take us through the story and we'll take it from there.
Perfect. Good morning, everyone. It's nice to chat to everyone again. As Darby has said, it becomes quite monotone for me to stand up and talk to you. I don't like the sound of my own voice. That goes against what most people would think. So this is quite nice. And we do lose the touch of having questions with clients, not sitting on the table. So hopefully this introduces some of that and keeps it interactive, makes it a little more relevant for all of us. And hopefully there's some key nuggets that you can take away from today's session. So the question, where did it all begin? Why the name? So we had a client, a trust client, a beneficiary trust, widows, orphans, etc., that was looking for a solution that would give them regular income. So we looked at it, or the team back then looked at it and said, okay, there's a number of different asset classes that can use that generates income. Group those into a product. But what we also realized is that you don't just want income. So yes, we distribute monthly to give that income provider feel, but the capital also needs to keep up with inflation. And for us, the key number there was inflation +3. So we set out the portfolio to generate an inflation +3 number using income assets that can generate or distribute income on a monthly basis. And basically what the mantra is, what we try and sell is a CPI +3 mandate, people that you want to beat inflation, but you don't want to lose money. And that's how the fund started. And obviously since inception, we're showing you here very successful in doing the CPI +3 with minimizing that capital loss or not losing money for our clients. And then the name, obviously income provider, just speaking again to that income generating nature of the product on the portfolio. And as I said as well, we do distribute monthly, which is something that we need to the portfolio.
Thank you, Henk. I think, maybe just touch on this. We didn't expect the fund to do as good as it has over the last, since inception. I mean, almost beating the multi-asset high equity category there. Longer term performance numbers. What do you want to achieve from the fund risk-wise? Just take us through that as well.
Yes. So as Darby said, obviously the power of compounding positive real returns is evident in this slide. So what we're just showing you here from inception compounded, as we've compounded these positive returns, we've actually outperformed most of the categories in the market with a lot less volatility and a lot less capital movement in the product. So again, taking it back to why we started the fund, we want to generate income. We don't want to lose clients' money. And the beneficiary trust that we started for, you're drawing this income, but you keep up with inflation. So a very good solution for them. And as Darby said, the recipe actually has worked really well. And going forward, it's the same recipe we'll follow. So what's key here is, again, as I said, we're trying to find sources of income. So it's a nice diverse pool of assets that we use, and our ability to use them is what sets us apart. And then obviously, as I said, that risk management undertone, that's very important. Clients don't want to lose money in an income portfolio, and the flip side of that is that you get to compound these positive real returns and have a market-beating recipe at the end of it.
Yeah, I think you've touched through most of the slides coming up now. Maybe you can jump into the team. Everyone knows you, but at Prescient, it's not about a star manager. There's a team behind you. Maybe take us through the team.
Okay, so yeah, just again, take a step back and show you guys the process slide again. So I've highlighted how we try and find different sources of income generating assets, and this really is our tool set, our toolbox. This process slide has really been there since the start, and just shows us the different drivers of real return we can use, all the different building blocks, interest rates, credit, sweetness, the different products we can structure, inflation-linked assets, interest rate-linked assets, preference shares, property, and then also the offshore component. But the most important part of this process is this risk management undertone. Again, focus on managing the capital risk in portfolios is very important to us at Prescient, and specifically in this portfolio. And people often talk about risk management and how you're managing risk, etc., but can't really quantify that. So for us, it's very important to put an actual number to our risk management. And for us in an income portfolio, again, speaking to not wanting to lose money in this portfolio, our target is to not have a capital drawdown over any rolling 3-month period, or any rolling quarter for that matter. So what I'm showing you here is since inception of the portfolio, our rolling 3-month number, you can see very successfully we've actually been able to not lose money over that period, except for one observation. Briefly during COVID last year, obviously we all know what happened there, a lot of lessons learned, etc. But you can see how quickly we've rebounded, and we get that signature back of not losing money in this portfolio, focusing on managing that downside and compounding those positive real returns. Then we often get the question, so you say CPI plus 3, but over what time period? So what we're showing you here is calendar years, and it's not over calendar years. We don't try and do CPI plus 3 every year. But the focus is on positive real return every year. So every year, eke out inflation plus return. You can see the gross real return since inception. Some great years, some other years not so much. But that focus on positive real returns and compounding those is what we are out for. And then the CPI plus 3 target, for us, we try and achieve that through any full interest rate cycle. So why do we say that? Obviously, interest rates is very key for this portfolio and the product. If we're targeting CPI, interest rates and inflation obviously speak to each other. But really what we're trying to say there is that we have the ability to do this through any cycle. So an upward sloping yield curve, an inverse yield curve, a hiking cycle, a cutting cycle, as well as a flat interest rate cycle. And that really speaks to our ability to generate real returns or income generating assets using the building blocks, asset allocating, understanding the risk, taking the risk where we deem it appropriate, and then managing that risk. So it's very important to get that message across as well. We don't put a time frame on the CPI plus 3 number. We try and do it through cycles to showcase our ability to do it through any cycle. And then that focus every year, just eking out positive real returns, is very key. It's important for us to reiterate these aspects or characteristics of this portfolio, because often what we find, and looking to the attributions for the second quarter, is that we'll be ahead some quarters and we'll be behind other quarters. But for us, it's not important where we are in relative to peers. It's very important for us where we are relative to our real return targets. So just showing you this, and we put the caption there, we're not a one-trick pony. So 2008-9, there were some good credit funds. 2009, there was a crash. Some guys lost 10%. They're not around anymore. Property was a good asset class for some. Start of 2017, we saw the crash. They're not around anymore. Credit, again, the same story again now. If we do have to have a credit event, some of the credit names would be in trouble or under pressure. And similarly, duration. Obviously, duration is key now. People are taking bond exposure, and we do agree with that. We do think there's value, but it's about understanding the risk in that, and the different drivers of real return is important. So diversification across find those real yielding opportunities, put them in the portfolio, and manage the risk. So just going through the assets here. So this is for the quarter and really speaking to the Q2 webinar and the update that we wanted to do. What's important for us here is to seek positive contributions from all the different asset classes that we are using. Some key comments around this. A little bit slower in June. Why? We saw the prefs or the preference shares we own give back some of the gains we've seen. So fourth quarter last year, we'd recall, strong quarter for the fund, strong quarter for the preference shares. We started out fairly well this year, and again on prefs you can see in April, but in June we gave some of that back. So you'll see these asset classes come and go, but the combination of them and the positive contributions through all of them is very important.
So question popping up here, but we basically covered it. So the comment is that year to date 2021 is not that great. What is our expectations for the next 6 months? We are going to get to the expectations, but I think bringing it back to what we've said at the beginning, we're not there to beat peers. We're there to beat inflation. We're there to risk manage. I don't know if you want to elaborate on the comment.
Yeah, so I think shorter term periods, there will always be leaders and laggers. And as I say here, we're not a one-trick pony, so you don't want to be the guy that's running when just one of the asset classes run. We try and generate a consistent positive real return using all the asset classes, and through time compounding that, as I showed at the start, you actually have a market-beating return. If you looked at that slide, the bottom line was the average of the category and the top line was us, regardless of the risk in between. So I mean, it does work, and that's what we always sell, and will be true to that. Shorter term for us, it's not, we don't focus on the peers. We don't try and chase markets. We understand the risk around every asset class that we introduce, and we try and generate our inflation plus return. If you look at the current yield that we've been able to build into the portfolio of around 6.6%, inflation around 3.5%, 4%. Again, there's a positive compound effect of those positive real returns from that. So year to date, slightly ahead of inflation. I think if we double where we are currently, we get to 6.5%, 7% on a conservative outcome. I mean, we get to our inflation plus target. So the key is, and we'll talk about it a bit later, we've seen a structural shift in our market, certainly from an interest rate perspective being so low. Finding opportunities to generate real yield is not that easy. And it's important to understand that in such environment, the probability of underperforming inflation is the highest it's been. And for that reason, it's very important to make sure we get that risk management right. So we're not there to shoot out the lights. We're there to give you that compounded, consistent, positive real returns over time. And the shorter term periods, we don't get swayed by what the market does, nor what our peers are doing.
Yeah, and as you mentioned on the slide, it's not coming just from a duration allocation to fixed rate bonds or credit or preference shares. It's a diverse set of asset classes that's going to continue giving you real returns into the future. Yeah.
Cool. And then, sorry, Dabi, I jumped ahead with your team question. So we thought it'd be a good idea to introduce you to the broader team. I get to speak to you mostly, but there's a big team behind me, and we all look towards this portfolio. So what we've done, and you would have seen some communication around how we've structured our team earlier this year, was the promotion of Bastian into our CIO role. We've siloed our teams, and silo doesn't mean that we all operate on our own, just means that we're focusing on the different aspects a lot more closely than some of the other guys out there, but there's very strong collaboration within the team. So on the left here is our cash and our income team. A recent joiner being Myresh Kulkarni from Fairtree, very, very smart gentleman, very excited to have him on board, and certainly showed us some great value from May when he started. And then the rest of the team with Michelle looking after the more money market cash type investments, Jabulani being portfolio manager with us on the income side, and then Ismail and Ihsan, the engine room as we call them, cash management, making sure the deals are settling. Cash flow in this industry is very, very important, and that's where everything starts. And then the two of them very, very capable in that regard. Then our bond team with Riza heading that up, and Visal feeds into us in terms of bond views, etc. They couldn't be luckier. Very, very smart combination there. And then on the credit side, you can see the focus, quite a number of new joiners, a strong focus on fundamental as well as quantitative. And for us in the portfolio, credit being a return driver, but also a very strong risk driver. So with this team, really the process that we run, looking at the credit, backs us up, and we're confident that our ability to avoid the potholes in the past is still there, and they look after us from a credit perspective.
I think something that's topical, and as the slide points out, something that's topical now is the steeper yield curve that we're experiencing and the inflationary fears in the global market. What is your view, and how does that translate back into managing the portfolio?
Perfect. Yeah, we've highlighted this before, and obviously it's important to talk about inflation globally. I mean, there's a chart that we like to look at, and if you look at the earnings report from the S&P 500 companies and the amount of times they mention inflation, that's certainly spiked up, and it's a topical discussion, and I really think this chart that we're looking at is really why that's the case. So what we're looking at here in very simple terms, if you look at the interbank market globally, every night it needs to square off to zero. Where there's a deficit in cash from the banks, the Federal Reserve, this is looking at the US market, pushes cash into the system to get it square, and where there's excess cash, the banks push it back to the Federal Reserve. And this really is that facility that the Federal Reserve has, or the reverse repo facility. And what's very, very starkly obvious here is that there's a lot of cash in the system. Globally, every night, banks, money market funds, and certain institutions are putting cash with the Fed, taking it out of the system at zero interest rates. So basically what it tells us that the guys have nothing else to buy. There's way too much cash in the system. Anecdotally, some of the banks tell their corporate clients that have a lot of cash for them, please take your cash away from us, give it to money market funds. We don't know what to do with it. So certainly, system from an easy financial conditions or easy money perspective, there's a lot of cash in the system, and this is obviously evident in this chart, and that's why that the debate and the question around inflation and the fears of inflation running away with us is prevalent. What's interesting for us is on the back of this, obviously we've seen the yield curve steeper or go steeper, specifically again the US. And for us, what's interesting is the market seems to be a little bit short-sighted, or at least their memory is a little bit short. If we think back just to last year and to previous episodes, I mean, the best indication or indicator for a recession is an inverse yield curve. And often when we start seeing, curves going towards the inverse, so the long end rate being below the front end, markets start getting worried about recession and risk off, etc. And this time around it was the flip side. So we saw the curve go steeper and markets just collapse all over themselves, saying there's inflation coming and it's a risk, and Federal Reserve's going to have to hike rates, etc., etc. So from our perspective, a steeper yield curve is a good thing. A little bit of inflation is a good thing. So we actually interpret this the other way around. What's interesting, and what is the risk, is that if this curve had to flatten and we had to see rates from the front end move higher, and this is again just looking at the Federal Reserve, looking at their 3-month rate that's going to start in 2 years' time. So what is the market pricing in for interest rates? Yes, we're seeing a little bit of an uptick there, but certainly that doesn't tell us that there's a hiking cycle on its way, tighter financial conditions, and then all the negative spin-offs from that globally. Looking at it a little bit differently, so the US federal funds and how they're pricing for that. Yes, this is the current line as the top one here. Expectation for some interest rate increases, but you have to look at the scale here. I mean, the current Fed, the band is 0 to 25 basis points. There's 35 basis points. We're not really even getting there. So yes, they're expecting some sort of increase in interest rates, but it's certainly nothing close to an interest rate hiking cycle. The Federal Reserve has really given us their playbook as well. They first need to taper buying bonds, then they'll indicate to the market where they want to go before they even start thinking about raising rates. And certainly we don't see a rate hike cycle materializing, and the steepness of the curve in that regard for us is a good thing. So we don't just go and say, okay, we think steepness of yield curve is positive. We actually do some numbers around this. We are systematic. We do want to let the data speak for itself. So what we've done is to use the yield curve as an indicator and look at what asset classes actually do well in an environment where we see steeper curves globally. And you can see on the left-hand side here, the different asset classes that we specifically use, an income provider do well in a environment where curves are steeper. SA property, SA bonds, SA inflation bonds, prefs, a positive, slight positive correlation. SA income as a category. So we interpret this steeper curve, this chat around inflation, picking up, etc., as a positive, and we do expect SA income and specifically the income provider portfolio to do well in this environment.
Thanks, Henk. Taking all of that into account, how does that translate into the interest rate outlook for South Africa?
Yes. So similarly in South Africa, it's interesting. People are starting to price in interest rate hikes, and this is what we're showing you in this chart. So basically what the forward rate agreements tell us is what the market expects 3-month interest rates will be at the different intervals in time. So in 1 month's time to in 21 months time. And basically you can see from where we are currently around 3.7, which is the JIBAR rate, to about 5.6, 5.7 in 2 years' time. We think that's quite aggressive. So certainly market is pricing in interest rate hikes. But if you go and you look at what the inflationary expectation is from the MPC and the SARB really in the outer years, and I've highlighted the circle here, so end of this year, end of next year, and the end of 2023, inflation is very well behaved. Certainly don't think inflation is running away with us. And for that reason, we do think that the market is probably a little bit ahead of themselves. We would interpret this as more the curve being very steep and that back end pulling up the front end, and not really the market expecting interest rates to be higher by 1.5–2% in 2 years' time. Again, if you think back to what I said about the Federal Reserve, we don't think we'll really react in the local market before the Fed starts moving. So for us, the interest rate hiking cycle is probably off the cards for now. Yes, we can see some adjustments. We saw 3% cutting last year, so yes, some increases likely and even possible, but certainly nowhere near a hiking cycle that should indicate tighter conditions in the local market. The market is worried, and they keep referring to the quarterly projection model, the QPM model that the MPC uses. And this model indicates that interest rates needs to be higher. So this is what this chart is trying to show us. So at the end of this, so this is the different meeting dates and where the model had interest rates for the different years. So where it currently is in end of this year, end of 2022, and then end of 2023. And you can see certainly there's expectation for rates to be higher. But we always caution clients to take a look at this and say, okay, when did they introduce this model? About 4 years ago. Look at what the model said and what they've actually done. It's starkly different. So this gives us an indication of what sort of direction they're thinking in, but certainly no indication of how much they want to move rates by and where. They don't try and get to these numbers in terms of where they put rates. So it gives us a sense of where they're going, certainly not a sense of how fast they're going to get there. So we would dispel the myth that the QPM is telling us that rates needs to be at 5.5%, 6% in 4 years' time or 3 years' time. Certainly not the case in our view. Then just lastly, just want to show you this. So how the MPC votes is very important to try and understand the dynamic again. So you can see from last year where they cut rates. So cut is the black. 5 members voting started to sort of take that off. Some guys said, look, let's keep rates steady, and where we are now. So certainly moving towards a more neutral stance, but nowhere on this chart do we see any sort of mentions of anyone voting towards a hike. And certainly we need to start seeing that before we start to believe that interest rate hikes is on the cards. As I said, yes, they might move end of this year by 25, sometime next year by another 25, but it's certainly not a hiking cycle as the market is pricing.
Thanks, Henk. I think just in practical terms, perhaps explain what the FRA curve is, how you use it to measure market expectations. If the rate starts moving up, how does a one-year duration affect the portfolio? Just bring it back a little bit practically for the audience.
Yeah, so the FRA curve, what I showed you here, we can go back to it. As I said, basically tells us what the market expects a 3-month interest rate to be at any point along the curve here. So this is in 1 month's time, in 2 months' time, in 3 months' time. They expect 3 months rate to be 4%. Currently, is 3.7, so that gives us 0.3% higher than where we are currently, and basically telling us that they think that the MPC is going to hike rates in the next 3 months by 1 interest rate hike. So we don't forecast where rates are going. That's not what we do. We're not point forecast house. We systematic. We try and quantify outcomes. So what we do is we'll take this and say, okay, what's the market price? What can we buy currently in the market based off this? And if we're wrong, let's stress it. Let's say, okay, they hiked by 1%. What is the outcome? If we buy a fixed asset, introduce some interest rate risk versus a floating asset, which one is outperforming? So we'll do a scenario analysis. If the fixed rate shows us this value, even if we're wrong, then we'll go into the fixed rate. We'll buy a 3-year fixed interest rate instrument. If it shows us, no, listen, floating is actually going to outperform, then we won't take interest rate risk. So we'll use this, what the market price is, build scenarios and try and assess potential outcomes and where we think value is in the different interest rates we can buy. So always try and see what's the worst case. If we're putting risk on the table, if we're wrong, are we underperforming our risk target? By how much can we be wrong before we start losing money, etc. So quantify potential outcomes, try and minimize that downside risk, and don't spend on risk if we don't have budget to spend on.
Thanks.
Cool. And then I thought I'd just update us on we have spoken to this at length in previous webinars, but on the structural shift we've seen in the front end or interest rate market, and certainly what's happened. And if you think back to the slide I showed you on the Federal Reserve reverse repo facility and all the cash that's in the global system and certainly in the US, we have the same situation in the SA market. So this is just cumulative deposit growth at the top 4 banks in South Africa, and you can see last year people de-risking, the SARB helping out the market, etc. A lot of cash that's found its way to our banks. You can see this year because of all that, and what I'll show you now in terms of what banks are paying us this year, it's fairly muted. And on the flip side of that, obviously on the credit extension side, so banks have the cash but not really putting out the cash into the market. We all know why this would be, obviously the economic situation where it is, lockdowns, etc. Bank credit committees don't want to take risk, as well as the market not really having appetite for risk. So we see cash, but not the flip side of getting it out there. And this is the result. So what are we getting paid for putting our money with the banks? And you can see throughout last year how that's collapsed. So basically this is the funding spreads, or how much spread we're earning on top of that 3-month interest rate, which is the turquoise line, for the different tenors putting your money with the bank. So how much do we want to get paid for taking bank risk? You can see how that collapsed throughout last year because of all this cash. Yes, we've seen it tick up a little bit, normalize slightly, but if we have to compare January 2019 for a 1-year instrument, so that's the 12 months, that's 80 basis points or 0.8, plus whatever the rate was, say 7, so 7.8 for a 1-year instrument. Similar, Jan 20, about 80, again about 7, just under, so let's call it 7.5 for putting your money at the banks for 1 year. Now fast forward to where we were this year, 4%, 40 basis points, so 4.4 for 1-year risk. And why is this important? If we overlay the inflation expectation of each of those years, 2019, 2020, and we can take it back further, there was expectation of generating real return or a real yield from money market or cash type investments. Fast forward to this year, that's not the case anymore. If we expect inflation of 4.5, 1-year money market is giving us 4.4. We are under inflation for that year, and that's the structural shift that we've seen. And that's very important. As I said at the start, we try and generate inflation plus a positive real return. And one of the tools we have is this. It's now off the cards. So how do we now focus on getting that real return? And again, as I said at the start, we have the ability, we have the toolbox of using different real return drivers, different instruments of income generating assets that we can allocate to, and we are strong in asset allocation, find our real return. And as I said earlier, 6.6 12-month forward yield, a very good yield that we've built into the portfolio using the different tools. And then we've got that the risk management undertone and the protection, which I'll share with you at the end, that we build into the portfolio, that if we are wrong in any of our allocations, certainly the protection is there for the portfolio.
Sorry, Henk, one slide back. I think everyone understands sort of the inverse relationship between duration and interest rates. And I mean, if rates move up 1%, you lose theoretically 1% if you've got 1-year duration. How does spreads affect the portfolio? So differentiate between spreads and interest rate and term and duration.
Perfect. So just again back to this slide. So interest rate risk, as Davi said, that's duration. So if interest rates move, your risk there is linked to that. So again, if we have 1 year duration as we have currently in the portfolio, rates move up by 1%, that is a capital knock on the portfolio of 1%. Taking that away from this and putting it into the credit bucket, there we don't have interest rate risk because mostly we buy floating rates. So your interest rate risk, you move as the market moves, so you don't have capital exposure to interest rates, but where you do have exposures to spreads. And that's the price of credit. And what I'm showing you here is really bank credit. So this is the most senior, highest quality credit in the market. But the rest of the market prices off this. So as these things move, the rest of the credit market also moves. And the spread risk is very important to understand. So if I had to buy a 3-year asset, 36 months, the current, let's say we were buying it here at 60 basis points. So that's the spread. So this is the price of that spread. And it moves to 80. That's 20 basis points for 3 years. That is, what is that? That gives us 60 basis points of mark-to-market loss. You can accentuate that if you're going into the more sort of corporate credit market. The spreads on a 5-year basis, where most guys issue, goes from 2% to 3%. Your portfolio loses 5%. So it's very important to distinguish between interest rate risk that's linked to the interest rates and spread risk that's linked to the price of the credit and the spreads in the market. And it's not a well understood concept. And certainly it's an underlying risk in a lot of portfolios that they have a lot of spread risk in the fund, where if spreads had to move, and again, I allude back to 08, 09, where we had some credit events happen, portfolios took 5, 6, 7% knocks based purely on the move of spreads and not on interest rates. So it's important to understand that obviously counterparty risk is one thing, but spread risk in credit is also very, very important to manage and understand. How do we manage that? Obviously, a very strong credit process. We understand the pricing of credit. We look for value. So if we're not getting paid for risk, we won't participate. And then we also manage the term. So the longer the term, the higher the risk. So we manage the term shorter, that when we do see movements and spreads, the impact on the portfolio level is less.
A further point I've noted here is commenters, spreads seem to be quite sticky in the SA market. Is there a specific reason for that?
Yeah, so the SA credit market is a little bit dysfunctional, and that's maybe not the right word to use. But what we've seen with the popularity of income funds growing, a lot of cash chasing not so many assets. Obviously, with where the economic cycle was, corporates and banks not really issuing credit. So you have a lack of assets to buy with the excess amount of cash wanting to buy them. So what we saw is spreads almost unnaturally compressed. So what you would theoretically and historically see if economic cycles turn, quality of credit goes down, the price of credit or the spread that they have to pay to get cash goes up. We've seen the reverse happen. So quality has gone down, but price has also become more expensive, or spreads have compressed, and that's because of the too many funds, too much cash, not enough assets. A similar story is in the SA market, and also why it's dysfunctional is the credit doesn't really trade, and for it to really mark up and spreads to move, we need to see it trade. And a lot of this credit is very illiquid, and unfortunately doesn't trade, and the price discovery in the underlying credits is not that clear, and that's certainly also a risk. So again, for us, we focus on quality. We like liquidity, shorter term assets, so we are comfortable that the credit we own has traded and it reflects the current market level. But a lot of the credit in the SA market doesn't trade. It's held by guys, it's not really trading. And certainly if there's liquidity events again, we could see some spread risk in the market.
Thanks, Henk.
Perfect. So maybe just an update then to take it all back. We are looking for drivers of real return. We are managing the risk. We've seen a structural shift in the SA market. So now we've got to use our other tools to generate our real return. So what are those currently? And very in all briefness, again, one offshore component, we like SA counterparties in the offshore market. We don't take currency exposure. Our risk target is fairly conservative. We don't want to introduce that volatility. So we like to use the interest rate differential. So basically buy a dollar, sell the dollar and buy it forward in rands. The interest rate differential is what you get as a pickup. So dollar yield of 2%, 12-month interest rate difference of 4% gives us a 6% asset in rands. And if you compare that to the local equivalent, there's value for us in having offshore. So simple philosophy in using offshore, it's a yield play, it's not a currency play, and we understand the SA counterparties better than the offshore market, and where we see premium in those, we'll play. The second one, duration, we've spoken to that at length, but certainly in the current context, in the current environment of the steep curve, we do think that there's value in owning government bonds, and certainly in the portfolio currently, it's an anchor tenant. We've got 1 year duration. That's very well, I mean, that we understand really well. We've done the numbers, and that's the number we want. We don't think an income fund should be heavily duration heavy portfolio. Again, think about our risk, think about the rolling 3-month number. What's the value? How much can we take? If we're wrong, how much are we losing? And that all that into the pot gives us a 1 year duration number. I'll show you at the end how we actually look at that number and what bonds to buy. But certainly from a government bond perspective, there's a lot of value. We want to lock in these great real yields for as long as possible, and then manage the risk around that. Preference shares, showed you earlier a bit of a detractor last month, but certainly we still think there's a lot of value. If you compare what the banks are paying in terms of the preference shares versus where cash is, that spread is still quite a way from its long-term median. It's come in quite a bit. It has worked, it's flattened out a little bit, but certainly we understand the risk around prefs. I've spoken to this at length as well, but really prefs sit outside of the capital stack. The Prudential Authority or the SARB has no authority over that, and then we don't see any dividend risk in prefs. So for us, it's a great yielding asset. It's something we'll exploit. Top 4 banks, we don't think they're going anywhere. And again, a great real return driver in the context of where interest rates not really giving us that real return that we want. But inflation-linked bonds, we like inflation assets. Apologies. Anything that's linked to inflation is great for this portfolio. We have this inflation mindset. So if I can buy an asset that gives me inflation plus, that's a great asset. If you look at the front end of the government inflation-linked bond curve, the real yield plus whatever we're expecting for inflation, that expectation of inflation doesn't need to be all that high for us to outperform the cash component or the cash market currently. So we like that. Again, to the story we painted around inflation, probably seeing a little bit of inflation going forward. This is also a natural hedge against that. So as we see risk of inflation increasing, these inflation-linked bonds obviously do well, and gives us that underpin and that flavor of inflation in the portfolio. Also in this, we group our renewable energy portfolio, quite topical with infrastructure, etc. That's a CPI plus portfolio and very, very nice CPI plus returns. So we get there stable inflation plus returns. That's great for this portfolio. And then finally, property, fairly defensive currently, less than 2% of the portfolio exposed to listed property. We like it as an asset class. So if you think about the long term, your building costs should keep up with inflation. That should give your building or your asset a natural inflation underpin. And if they get to pay you something on top of that, that's great. That's inflation plus. We often tell the story of, you look at the Zimbabwe market and not comparing ourselves to that, but the only asset class that really kept up with inflation was their property market. So long-term, great asset for an income fund, but very important to understand the risk. Currently, a lot of uncertainty for us. Not a lot of dividend yield being paid. If you look at the index in terms of the dividend yield, it's really collapsed. So for us, not a lot of opportunity currently, but certainly in the long run, where we see a bit of value and feel a bit more comfortable, you can expect us to again be able to use this building block to get to our inflation plus target. Okay, then just some charts around what I've shared. So basically, this is comparing the SA dollar curve, so the dollar bonds that the SA government issues versus the rand bonds they issue. And then what we've done is just to convert the dollar bonds into rand. So that's this terracotta line, and then the local curve at the bottom. And then what you can see in the bar charts, which is the difference, is that the shorter term of the curve, so 9 years and shorter, there's value in owning offshore bonds and hedging it out versus the local bonds. So again, yield generation for us, finding those yield opportunities in the market, allocating to them to get to our inflation plus. And if you look at the back end with our steep curve, local rates do look more attractive. So not a lot of value in buying longer term dollar bonds, but certainly in the front end, risk adjusted, great pickup for us to own SA dollar bonds and hedge out that currency. Then again, around the interest rate risk in this portfolio, what I show you here, that's the 3-year rate. And you can see what we've done historically is where the rate would move higher or spike, we would increase the bars, which is our interest rate risk or our duration. So where there's value in taking risk, we will take risk. Where there's no value in taking it, we'll just take it off the table. Counterintuitively, this year or last year into this year, again, to the structural shift that we've talked about, we've seen that front end collapse. So that's this move here, but we've actually increased our interest rate risk, and that really speaks to our bond exposure. And this is the bond curve. So different maturities at the bottom. This navy line in the middle is your total return over a 1 year basis. So what do we expect if nothing happens from here to return on those bonds for 1 year? And then we just build scenarios around that. So very simplistically, a shift in interest rates 1% higher gives us this return, and then 1% lower gives us that return. And you can see here in this sort of 15-year and shorter part of the curve, a lot of value if nothing happens. Even if the market moves 1% higher, we are outperforming cash over a 1 year basis by owning bonds. So there's a lot of value. Yields are high. You're getting a lot of compensation from an interest rate perspective. But what's also very important, and it's often not a well understood concept, it's because the curve is so steep, and that's what we're showing you here. So this is the current curve, front end to back end, so shorter maturities versus longer term maturities. And then just comparing it to 2016, you can see how flat it was then. So what's very important with a steep yield curve is if I buy a bond today that's yielding 10%, that's my interest rate. That's what I'm getting. Tomorrow it's a day shorter than it was yesterday. So every day it becomes shorter, it moves down this curve. And this is on a yield basis. So as it goes shorter, the yield goes lower, lower, lower. As the yield goes down, the price goes up. And you have a capital benefit from rolling down the curve. And that's very powerful. So if the curve had to move, tomorrow it's a day shorter, you're moving down. So you've got that natural protection for rates moving higher against your view of this pull down down the curve or the roll down of the curve. And that's a very important concept in fixed income to understand. That's also why we like this area of the curve for bond exposure in an income portfolio, because you have this natural protection of the roll down in the portfolio. And then just very briefly, finally, we've done a lot of work around what is the optimal allocation within our 1 year duration number. So not changing the risk in the portfolio, but looking at the composition of that 1 year duration. And there's a lot of work that goes into this, a lot of data, a lot of total return, risk adjusted stuff that we do. And this is the current optimal portfolio allocation. So a little bit of the shorter term, sort of the benchmark, and a little bit of a longer bond just to give you that yield. And then we balance it out with some cash. Okay, so that's on the duration side. On the bond side, as I said, we don't want to be a portfolio that just does well when there's duration. It introduces too much risk. You have to understand your risk number, look at the allocation within the portfolio, and for us specifically around that 3-month number, don't want to lose money over rolling 3 months. You need to understand what that bond allocation introduces in terms of risk. Okay, then just on the preference shares, so this is the spread between preference shares and cash or JIBAR. Long-term median in the red. You can see throughout, or with COVID last year, the spread going to all-time highs. So this is the difference between cash and prefs. I mean, it was very, very attractive. It did well for us. It sort of flattened out a little bit, but still we're earning in excess of 4% better than cash. And again, if you think about our view that cash has really moved away from giving us real return, buying preference shares for these yields, top 4 bank risk, which we understand well, this is a great asset class and we'll keep holding on to it. Okay, so taking all of that, putting it into a pot, what is the risk in the portfolio? Really what we've done is we've identified 2 key risks in what we've currently allocated to. One is the offshore component. Yes, we hedge out the currency, so we're not taking currency risk, but SA is an emerging market. And if something goes wrong globally, we all understand that there's risk in the global system. If that does have to play out, emerging market spreads and yields will move higher, and that component of the portfolio is at risk. So how do we protect against that? We will build protection strategies into the portfolio. Currently, it's in the form of currency options, or more simplistically, if the rand had to weaken, those protection strategies would pay the portfolio and would offset the risk in that underlying component of the portfolio. Then the second one is duration, and we've spoken to this at length, but here really is the interest rate risk. So if interest rates had to move higher, the portfolio will be exposed. We don't want that, so we just buy protection that if it happens, we get paid for that move. That little bit of benefit we get goes back into the portfolio, gives us that smooth ride, what we call asymmetric return profile, so downside protection with upside. And then really what the key and the value of that is that if we get to those higher yields again, and we were able to ride high without taking the knock, gives us the ability to again lock in those great real yields for even longer term. Okay, so great asset allocation, focus on the different assets that give us real return, look at the risk and build in protection to make sure we give our clients that smooth return profile as we generate the income for them on a monthly basis. Cool. So current portfolio allocation, this is as the end of June. You can see that the diverse mix of assets that we are using, fixed bonds being this block with the duration play, 50% offshore that's hedged, a little bit of offshore protection, so that's just on the effective exposure, but I have to show that for you guys. Inflation-linked bonds here, 10%, nice inflation underpin, small property allocation, the prefs, yes, introduces some risk, but some good yield, but it's managed, so there's 3.4% there. And then we use the different ones to build up the yield. So 6.6%, nothing happens going forward. What we expect to return. This excludes the roll down in the yield curve, so it's a conservative number. But with 1 year duration risk, we think that's a great yield for a portfolio, and certainly gives us to that inflation underpin.
Maybe just there, showing the current yield and duration there. Question around if someone wants to use this fund in a living annuity, what is the expected net yield or distribution that the client can expect? I mean, maybe I can touch on it. I mean, we do this monthly income provider report, and not the full yield is distributed. A portion of that is rolled up out of the offshore component, which is not distributed. So the current net distribution yield is at 5%. So that's what one should expect on a monthly basis. I think that's also another important point, is that the fund distributes monthly, not quarterly or biannually, like a lot of other income funds in market. So it is quite well suited for a living annuity client drawing down that rate.
Perfect. Cool. And then just in summary, focus on this delivering real returns, true to our nature. It's why we started the portfolio. It's the mindset we have. Manage the capital risk, certainly in the current environment. The risk of underperforming inflation is the highest it's certainly been in a long time. So focus on that. Make sure we build protection into the portfolio around this allocation to the different real return assets. And we remain conservative on the credit side. We don't think the market is priced efficiently. We are finding value in certain areas of that market, but certainly our quality is high, our liquidity is high, and our term is shorter. And just to understand all the different risks, and then compound those modern real returns, and just enjoy the ride. So, I mean, that's it from our side. Thanks to Darby and to all the questions that's come through. I'm not sure how we're doing on time.
Oh, it was quite a long session today, but I see there's one question on China. Henk, do you want to comment on China? No, I don't think we're going to cover that today. So we've got a multi-asset webinar coming up in the week, and then China update on Friday if you want to ask those questions there. Last question I see, current cost of hedging in the portfolio. I think touch on the put options on the bonds and maybe on the currency side as well.
Yeah, that's a very important question, and thanks for asking that. So we always try and evaluate what it costs us to buy protection versus the actual protection it gives us. So it's cost effective, and then to create that asymmetry. So what we've actually seen, if you look at volatilities, etc., those have come in. So the pricing is not that expensive currently. On the offshore side, on the currency side, it was about 25 basis points on a fund level for 9 months worth of protection. So on a monthly basis, you can work out not a lot of basis points that we spend from our yield to give us that protection, and certainly 10% of the portfolio is what we've hedged in that section. And certainly if something goes wrong, that will give us very, very nice protection in that part. And then on the bond side, or the duration, the puts we've bought, that was about 4 basis points. So very cheap, gives us good protection. The way we would think about protection is at what sort of levels do we want to start being protected. So that would be our strike level, and then see how much that costs us. So that level will be informed by our risk target. How much of a rate move can we see before we go into negative territory? And then we'll start adding protection from that level. And again, the cost there was about 4 basis points. They mature in September. The currency options on the 13th, that's my birthday, I know. and then the put options in November. So quite nice long protection, and not that much yield that we had to give up for that.
Thank you, Henk. Thank you everyone for joining us today. Remember to congratulate Henk on his birthday. Have a great week further and join us for a multi-asset later this weekend, sign on Friday.
Awesome.
Cheers.
Thank you.